Securities offered through Cambridge Investment Research Incorporated, a broker-dealer, member FINRA, SIPC. Advisory services through Cambridge Investment Research Advisors Incorporated, a registered investment advisor. Cambridge and Clear Vista Financial are not affiliated. Discussions in this show should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions.
All right, welcome everyone. I'm Mark Trice, financial advisor with Clear Vista Financial, and this is our November monthly market update. I'm joined today by my fellow professional, Jesse Hamilton.
Hey everybody, welcome.
Jesse, it's been an interesting month. We had another one of those little rallies within a bear market, and we'll talk about that in just a little bit more detail in just a moment. But thank you for joining us today. We will jump right in, and today we're going to kind of cover how the indexes did in the month of October. We'll kind of give you a general economic update, and then we're getting a lot of questions, especially from radio listeners. We're getting a lot of questions from folks that are asking, why isn't inflation going down? And we're going to talk about that just a little bit as well. And we'll answer your questions if you have any. You can put those in the question box on your control panel. If we don't get to them today on the program, we will respond to you within a few days, hopefully on Monday or Tuesday of next week. So great. Jesse, why don't we go ahead and jump in? I'm going to go ahead and put the first slide up. Let's talk about, I'm going to turn my camera off so we can see the slides better. And
sure, I'll kick it off with the S&P 500, which is the large cap stocks in the United States. This index had quite an exciting month during October, plus 8.03% during the month, but that's a part of a greater minus 18.76% year to date. And on October 13th, you can see right there in the middle of the month, there's a big green candle with a candlestick that's low, and that set a new intraday low for the S&P 500, 3491. So that's just something that we wanted to point out. It didn't close there, it had a strong rebound that day, but we did see a new low point for the index. Anything you want to add, Mark, there? We'll move on to the next one. The next one we're going to talk about is the NASDAQ.
Which the laser pointer was stuck and I couldn't advance the slide.
Oh. It's okay.
Sorry to our folks that are participating. I had a little technical glitch there. All right, so I wanted to add something really quick about the S&P because the S&P is now going down again.
Right.
I know Jesse said through October the performance was minus 18%, is now down about minus 21%. And that was on the news, and we'll get to that in a minute, that the Federal Reserve. But yeah, things are rolling over again in the S&P 500.
Yeah, I have a year-to-date slide here in about 5 slides, so I will show what happened this week.
Okay.
But yeah, next is the NASDAQ Composite Index, which is the tech-heavy sector. And as you can see, it doesn't look quite as nice as the S&P. We have a same formation, plus 3.9% during the month of October, but that's a part of minus 29.7% year-to-date at the close there on October 31st. And once again, there was a new intraday low of 10,088 there on that big green candle on October 13th.
So the NASDAQ year-to-date now through the first week of November, it's down about 33%. And those FANG stocks, the New York FANG stocks, that's Facebook, Amazon, Netflix, and Google, and Microsoft, and those guys, those are down about 43% year to date. So that's quite the move down.
Yes, it is. So next we'll talk about the small cap Russell 2000 index. Here, this one is plus 11.2% for the month of October. You might own a small portion of these in your portfolio. You can look for maybe a little piece of your 401k or something in the Russell 2000. But despite being plus 11.2% in October, we're talking minus 17.59% year to date.
So that's and that's gone down a little bit more in the last week, about almost 19.7%. So it's pulled back just a little bit through the
Yes.
first week of November. Usually we see the Russell 2000 small caps; those tend to lead the market when we're having a broad-based recovery. So this was a significant rally in October, but we'll talk about rallies within bear markets in just a moment.
So the last index we'll cover is the long-term Treasury bond index. And as you can see by this chart, it's struggling. It had minus 6.19% during the month of October. But the part that is really astonishing is minus 35.14% year to date.
These are bonds. They're supposed to be the safe haven for investors, or at least we've been told by the industry that the safe haven when stocks are volatile. You have a very different mix of factors that are impacting both stocks and bonds this year. And I think through the first week of November, those are down even further. Long-term treasuries down about 36.4%. So, that's more than likely, if you're not working with us, you're holding some bonds in your portfolio. And so you may want to take a look at that to see if there are adjustments that you need to make. I don't think that that we found the bottom yet, but I don't have a crystal ball, so I can't predict the future.
So this is what I always like to include in our monthly updates. This is the picture of the S&P 500 for the year to date. And if Mark, if you could get a little bit of a laser pointer or a clicker and circle the month of October there, but then right after it, you can see what happened this week. There's a series of red candles right there that show that it is rolling over again. And the screenshots that I showed you were just the month of October. We've had a full week in November now to see what's going to happen. And it consists of all red candles and it's rolling over again.
Yeah, and that in part was based on what some of the Federal Reserve said this last week, and we'll talk about that. But the interesting thing is, this is a bear market which really started for the S&P 500. The downtrend started in early January, right, Jesse?
Right.
If you go back and look at some of the other data for the bond indexes and the NASDAQ and so forth, those started a while ago. The NASDAQ really started to roll over back in November, and of course bonds have been rolling over for some time. So one thing that Jesse's I think was going to say, and I'm stealing this under. Sorry, Jesse.
It's all right.
There typically are rallies within the longer term trend, downward trend. And we've had two of these, well, really three significant ones since then. This rally in March, late March, early April, and it was kind of funny to watch, not funny in a haha way, but funny in a when the pundits come out and say, well, this is all over. We're gonna go back up to new highs. And I think that was Kramer on television on MSNBC. Kramer says the bear market's over, and then we rolled down and we had a very long decline through June. And then we had a little bit of a rally here in July and August. It was a pretty good one. I think that June-July August rally was up 18%. Mm-hmm. And then this long sell-off here was about 17%. Now the October rally from its bottom was really about 12%, and it's starting to roll over again. So this is very normal. Mm-hmm. I think that a lot of people think that bear markets are just straight lines and bull markets are just straight lines up. And you have to understand that there's a lot of rallies that will happen within the bear market. And what happens is a lot of investors that are scared get sucked in. It's like, oh, it's over. I'm gonna put my money in. We use technical analysis and we'd be happy to look at your portfolio if you need some help to get a second opinion. We use technical analysis, and we've had to be very cautious without that. So I think, Jesse, you were going to talk a little bit about some bonds and so
Yeah,
forth back from 2008, because that was the last
right.
significant bear market.
Well, real quick, can you go back to the slide?
Yeah, yeah.
Um, Peppered into this chart is lots of different events where the Federal Reserve took action or spoke in some way. You can see that peak in the middle of August. That was Jackson Hole, right?
That was, but even go back to June. I
Right.
mean,
They
June was
changed
when
their
they
word.
gave the Fed announcement that they raised rates, what, 0.75% then.
Right.
That
Everyone
was
liked that.
the second of the four rate hikes of 0.75% or more. And somehow the market interpreted that the Fed was going to capitulate and cut rates in the near future. Markets took off. And then you said up here in August 15th in Jackson
Yeah.
Hole, Fed Chairman Powell said, wait a minute, guys, we're what did he say?
I don't know his exact quote. He said,
Well,
"We are very serious about beating inflation."
right. And the markets go, uh-oh, he is serious. You know, the Federal Reserve has propped up the stock market for the last 10, 12 years. And now they're saying that they're not going to give us easy money and cheap money. Oh my
Right.
goodness. So market goes down quite a bit. How much was it? About almost 17, 18%, wasn't that recent
It
sell-off?
was, yeah. I only bring that up because we're going to talk about the Fed's most recent rate increase later in the presentation, and so I just thought it would be great for add context.
So
But
Jesse and I were talking about bonds earlier, but Jesse, why don't you jump into this?
sure, so this compares what happened in 2008. The orange line is the S&P 500. The blue line is a 60-40 balanced portfolio where 60% stock, 40% bond. And then the dark blue line is the US aggregate bond index. And as you can see, there's a 62% differential between the two, which historically we've seen this several times where they act inversely. But
Yeah, meaning bonds and stocks and bonds are not correlated.
correct.
Yeah. Okay. Let me go
So
back
then
here
what
to.
we're going to do is compare this exact same chart to what happened this year. And as you can see, they're actually correlated. There's no differential, barely at all. And this has not happened for a very long time.
Yeah, well over 50 years have we not seen this correlation, and a lot of folks are or a lot of financial advisors are constructing your retirement portfolios based on the assumption that bonds will bail you out when the market is volatile or going down.
Right.
That has not worked. And so don't rely on what's supposedly worked. And really this portfolio of bonds and stocks has not really helped investors for some time now, but we're really seeing the carnage in it when we have a bear market in the stock market. We've also had really the end, Jesse, of a 40-year bull market in bonds going
Right.
back to the early 1980s. That's over. We're seeing rates go up rapidly. That's causing bond prices and bond values to go down.
Right. Exactly. And we talked about on a previous market update how we haven't seen since 1931 that both the S&P 500 and the aggregate bond index have been down double digits. Right, Mark?
Yeah, I mean, there's only been 8 instances in the last 100 years or so where stocks and bonds were negative at the same time.
Right.
And only one other time, other than this year, that stocks and bonds have been down more than 10% at the same time. And of course, Jesse just mentioned that was back during the Great Depression, back in 1931. Now, that's not to say that we're in a depression or going to be in a depression, and we don't mean to say that at all. It just means it's one of those things that we as data people, data-oriented people, is just say, huh, that's interesting. I think the environment is completely different today than it was back in 1931, but we're seeing a lot of similarities to that time. We're also seeing a lot of similarities to what we experienced in the early 1980s.
Right. So this next chart is not intended to scare you. We just really like data, like Mark said, and sometimes it helps to overlay historical time periods together to see what's going on. The red line is the last 2 years up to the current date, and the blue line is 2008. So all we're trying to say here is hopefully not a Big Short movie remake coming to a theater you knew. We don't mean that, but it does show that we don't know where the bottom is. We could have already seen it, or it could be in the future.
Yeah, and that's one thing. And if you've never seen The Big Short, do not watch that with your children or grandchildren. It's not appropriate for them. But it really was kind of a docudrama, if you will, talking about the 2008, 2007, 2008 housing market collapse, and how a few people predicted that would happen and the reasons and rationale for it. And it's interesting to kind of see how the S&P, we're just really showing this because, we don't know where bear markets will end. We don't know where the bottom is. Now, if we are going into a potential recession, earnings on companies will fall, and that could bring the stock market down even further.
Right.
So that's just mean to say, hey, we're watching things. If you need someone to look at your portfolio, give us a call.
Right. So this is a comparison of the yield curves. The bottom
These are
yield
all
curve,
the treasury yield curves, the interest rates off of different duration bonds. So a 10-year, 15, 20, 30-year.
right. And the
And what's the
bottom
red
line
line?
was 1 year ago. And that's what we traditionally see in a yield curve, where the shorter bonds have lower rates and the longer bonds have higher rates.
So
That's what,
this is what a normal yield curve is supposed to look like, the red line.
right. But the line right above it is what we're dealing with right now. And that's a product of the Fed intervening and the high inflation that we're dealing with. But you can see how it's inverted. The shorter bonds are actually higher than the long-term bonds.
That's indicative, and actually this was as of the end of September, Jesse. Those rates are even higher as of Friday. The 2-year yield is way up here at 4.6%. It's off the chart, okay?
Wow.
The 30-year yield has risen a little bit too, but it's at 4.27. The 10 years at 4.17, and that really translates so all this first part of the yield curve is really inverted. It's higher than the longer term yield curve. That's indicative of, well, let's just say in the past it's been indicative of a coming recession. When we see short-term yields go up higher than long-term yields, that's indicative of a potential recession. So we just watch for it, right?
Right. Once again, we're not trying to predict the future or scare anybody, but we're just presenting the data as it is.
And this is also reflective of the Federal Reserve's efforts to fight inflation.
Right.
And because they're anticipating that this will change sometime, inflation will go down, because otherwise bond investors would want additional yield for longer dated maturities. But we're asking the questions, what if the bond investors are wrong this time?
Right. So with hopefully a little bit of a smooth transition here, I'm going to hand the lead over to Mark, and he's going to cover some more of our economic updates and news headlines, and then we're going to talk about inflation.
So yeah, thanks, Jesse. So I just want to do a little brief economic update. We'll talk about inflation reports that are coming out next week. We'll talk about the jobs situation, and we'll talk about the Federal Reserve's efforts to fight inflation and how to interpret the data that's come out. Okay, so on Wednesday, the Federal Reserve wrapped up their meeting for November and gave a statement, and where they lifted interest rates by another 0.75%, and that's to help combat inflation. They also signaled that they're going to keep raising rates, maybe in smaller increments. In fact, Jesse, you chose a headline article from the Wall Street Journal. This was similar to a number of headlines that immediately got blasted out around 2 p.m. Eastern on Wednesday, and the market took off for a brief moment, for about 30 minutes. And that was because the headline said something like this: Federal Reserve raises the interest rates by 0.75%, hints at rate decreases or something like that. I think it was the headline.
Yeah.
Or pausing rate increases, and the market took off on that. Then Chairman Powell comes out at 2:30 Eastern and gives a speech, which is basically just reading the press release that everyone's already read, but then he starts taking questions from reporters. And that's when, reporters started asking questions and realized that he was really saying, hey, we might do it in smaller increments, but we got to wait and see what the data says. And we're going to keep raising rates until we kill inflation. And he gave indications that in order for us to see that inflation is going down, we've got to see people losing jobs. We've got to see the core inflation begin to fall. And I think they're really trying to avoid making the same mistake that Fed Chairman Paul Volcker did in the 80s. And they actually, they stopped raising interest rates too quickly. They raised them fast, and then they stopped raising them, started cutting them. And really what they realized very quickly is they didn't do enough, and inflation reared its head again. And I think that the Federal Reserve is trying to avoid that, a repeat of that catastrophe that we had in the 80s, because it caused the country to go into a recession, that second round of rate increases. So, this is costing borrowers more money to borrow to finance cars, homes. Credit card rates will be going up, but one thing they did that he cautioned this last week is they might raise borrowing costs next year more than they have projected, which caused the market to go down. I wish we had put that one slide up of the minute chart of the S&P as he's speaking. So we believe that the Fed will be continuing to raise interest rates for some time, maybe not as fast, but this could very well go well into 2023. They have another meeting in December that they'll be raising interest rates probably. We don't know how much. And one thing that they did do is they did not provide any type of forecast for future rate increases. So this is going to start having an impact on the stock market more than it already has. It will be a struggle for the stocks to increase in price if there's a drag on the economy and we start having earnings estimates start looking a little bit more bleak. But that's the story, and that's why you saw in the last week or so the market turn over a little bit. Also on Friday, we had a little data that was a little mixed, and at first the market reacted negatively, and then it took off, and I think it finished the day up a percentage point or so or more. And U.S. employers added about 261,000 jobs in October. That's showing signs of resilience. That beat estimates. That shows the labor market strong. The jobless rate rose a little bit in October to 3.7%, but that's well below what economists have considered in the past to be full employment. And they also revised September's job numbers up, saying that in September the economy added about 315,000 jobs. So
people
really,
are very confused by this because it's showing resilience in the greater economy, but the Federal Reserve had just said that people need to lose their jobs.
Yeah, and that just means that the Fed's having to interpret this, and this probably means that they're going to continue they're going to continue to raise rates until they start seeing these numbers down. It's a little bit of a conundrum, right?
Right.
I mean,
Totally.
and Chairman Powell hasn't outright said this, but what he hints as is we have to kill the economy, or we have to slow down the economy.
Yeah.
I shouldn't say kill. No one wants to kill the economy. That's what we did during COVID.
Yeah.
But healthcare, professional and technical services and manufacturing sectors led all those gains. We saw average hourly earnings go up in October from the previous month, up about 4.7% from the previous year. But the problem is that we're working more jobs, we're working more hours, and so that increase in income is not keeping up with the pace of inflation. So let's talk about that just a moment. We talked about this at length on the show today, on the radio show, and we were talking about an article about Ben Carlson at A Wealth of Common Sense, is a website that he has. His article was, "Why isn't inflation falling?" And we mentioned this on the Spend Life Well show, but this gives some perspectives on why inflation is likely here to stay. Believe it or not, everyone got wealthier during the pandemic. And you're thinking, Mark, people were lost their jobs and everything else, but
Right.
what happened was the government started handing out money to everybody, trillions of dollars. And the reality is that the overall net worth of Americans climbed during the pandemic. And I've got some slides here in just a second to kind of show you the different parts of that. And then corporations, they've been able just to pass along those increased costs to consumers. Now, I don't know which side of the aisle that you're on in terms of your personal politics. There are those who believe that corporations are evil and they should be giving up their profits to help consumers. And then most not economists, but most folks that believe capitalism works in America believe that corporations should be passing on those costs. I think there's a little disconnect. I think that's designed to try to divide the country.
Mm-hmm.
I don't think corporations are evil, but that's what you might hear from some politicians.
Right.
But that's one of the reasons that things are getting a little bit more. Inflation's not slowing down that much. I wouldn't be surprised next week. We got the inflation print for October coming out on Thursday, and that might show that inflation slowed a little bit, but it's still going to be high. And we're seeing a lot of sticky inflation when it comes to foods and utilities and things like that. So when I say that everyone was not the royal wealthier, but collectively U.S. households got much richer during the pandemic. So the net worth of U.S. households.
This is across all types of households.
Right. The net worth of U.S. households coming into 2020 was just shy of 110 trillion. But by the end of the second quarter, net worth was up more than to 135 trillion. And coming into this year, net worth of U.S. households hit 142 trillion. So a lot of this was increasing, and these are probably the highest levels since the Fed's been tracking this data since 1989. And so we actually got collectively wealthier because of all the stimulus that was going out. Even the bottom 50% of the country in household earnings got wealthier. Their net worth increased from 773 billion to 1.4 trillion. So this is going back to 2000, the early 80s, 2000s, or actually early 90s. So in less than a little bit over 20 years, the net worth of this group rose by more than 621 billion. Now, we all know that the bottom 50% of income earners during the financial crisis 07 to 08, and of course the housing crash that during that time, this part of the demographics of the country were really hurt.
They really struggled.
Yeah, but by the end of 2019, it had come all the way back and then some. but now it's $4.4 trillion. That's the net worth of the bottom 50%. And meaning it's doubled since early 2020 by more than in just a little under 3 years. So that's quite significant. We've got more money to spend because the government handed out a bunch of money, and that's driving up inflation. Top on, the supply chain things, which is what they blame. No one's going to within the federal government is going to come out and say, well, because we handed out all this money, that's causing inflation. So it's really their fault for causing inflation. Now, the pandemic caused supply chain issues and so forth, but that has really begun and has really resolved itself now. We're concerned now that a lot of manufacturers have a lot of inventory on hand that they're not able to move, but there's still significant demand, and that's causing inflation to go up. Okay. And we talked about operating profit margins. We're not going to talk about this, but we've heard all the CEOs complain about higher input costs, wages, et cetera. But the way they respond to that is not to make less money. They increase the prices. And this is what companies will do when they're forced to deal with higher prices of those inputs. And so this is not an evil thing. Corporations are designed to benefit their shareholders, and they're going to attempt to make a profit. In order to do that, we have to raise the prices. So a lot of times workers will get blamed for demanding higher wages, and the government gets blamed for the spending binge that they had. But there's a little bit here that the corporations are doing too. They're just simply responding to their higher input costs. So we're not holding our breath that these input costs are going to fall dramatically. One thing that I remind people of is that inflation is sticky in many cases. You're not going to see these prices go down. You may see the rate at which they climb slow down, which we hope, and to something more normal. The Federal Reserve has a target inflation rate of around 2%, but they're a long ways from that. Last month, that was about 8.2, 8.1%, and we see that continuing on for some time. So all this data that I've kind of shown you today really means that I would not want to be the Federal Reserve presidents around the country, because they're dealing with conflicting information. Their data is not painting a clear picture right now. You see that we are having a somewhat resilient economy. We still see employers still hiring. We haven't seen a ton of layoffs. We see prices continuing to go up. And all those things lead Jesse and I to believe that perhaps inflation is going to be here a little bit longer, meaning that the Federal Reserve will not have a choice but to continue to raise interest rates.
Right.
Jesse, do we have any questions in the question box? I don't think I see any. Do you want to have anything you want to add?
Well, we got one question during the Fed, when we were talking about the Fed raising rates.
Mm-hmm.
And feel free, if you're listening, you can add it right now. We'll try to answer it for you in the moment. But does the Fed raising the rate mean it's going to be harder for me to get a car loan this month?
Well, I don't know your personal credit score and everything like that, but it will make borrowing costs higher. I think we saw this last week. The average borrower should expect to pay a little more than 7% for a mortgage on a 30-year note to buy a house, and I assume that car loans are going up as well.
Mm-hmm.
But the thing is, and for those of us that have been around for a while and maybe bought a house or two in your lifetime, we all remember. I remember my first house that I bought in the early 90s. I paid something like close to 8 or 9%. Now, I didn't have the most fabulous credit at the time, but it still was kind of the average rate. And I think we've become accustomed, especially for newer consumers, newer borrowers, that I'm used to interest rates in the 2s and 3% range, and 7% seems outrageous. yes, this will cause people to have second thoughts about purchasing large ticket items like a car or a house, and that may slow down resale of sales of homes and cars, but it's not all that bad. It does increase the borrowing cost. And so, yes, I don't know if it'll be harder for you to get a car loan now, but depends on your personal financial situation, but it probably will cost you more to finance that. So, any more questions, Jesse?
We have one more if you can take it. Is that all right?
Yeah, no, we got just a minute.
Okay. If bonds are doing so poorly, how do I remove them from my 401k?
That's a great question. I'll put this up here, put the camera on so people can see we're still here and not sleeping. So one of the things that we look at is, most people in their 401k have a menu of choices. Now, some 401k plans are better constructed than others, but most plans are going to have large, mid, and small cap stocks, maybe an international stock fund, and then they'll have a few bond funds. Usually you are allowed as a 401k plan participant to select what you want your funds to go into, how those things are allocated right now. And if you have trouble with that, you can talk to your plan provider about how to make those changes. If you would like to get some advice on what allocation is best for you, contact us, go to our website at spendlifewell.com. You can also give us a call in our office at 254-282-0495 or our 800 number, which I'll put up here there on the screen. It's a real easy way. Give us a call. You can schedule a consultation. They're free. We don't charge anybody for just talking to you and getting to know you. So you should take advantage of that. Jesse, I did want to point out that in just another week or so, we have a webinar coming up in the evening, Tuesday evening, last chance financial planning things that you can do before the end of the year. Now, if you're a client, we're already talking to you about these things, but if you want to listen on that, we'll give you some ideas of things, especially charitable giving, stuff like that. And that's November 15th at 6 p.m. You can register for that at spendlifewell.com and just click on the events tab there on the home page. All right, Jesse, I'm not seeing any more questions, so let's wrap up the show here in just a minute. There'll be a recording of this available to you. If you registered, we'll send that out in the next week or so you can listen to recording all the things we talked about. From Jesse and I, we want to thank you for taking a few moments out of your day to listen to our comments. Once again, if you have any questions or anything, hey, please feel free to reach out to us. We'd be glad to visit with you a little bit. There'll be a little survey that launches as soon as we're done here, and we ask that for your feedback on that. So thanks for joining. Have a great and wonderful day.